episode number 249 with Jordan Roy-Byrne. Welcome to In It to Win It. This is Stevie B.
And Dan G.
Dan G. How is the book?
Yo, I'm just chilling up in the book here, Steve. All is well. Very far removed from society. So, yeah, it's all going very well.
Nice.
Just hanging out with old girl, all ball and chain out here, you know.
Yeah. Bucaramanga, Colombia. Yes.
Yeah,
yes.
know,
South
it's
America.
where everybody goes.
Yeah. Like, yes.
Just out here searching. Yeah, I'm just out here searching for the elusive Colombian snow leopard,
I think you might have found one.
Yeah, I did. It was very elusive, but I was able to at least get one.
Yeah.
National Geographic's worthy.
Yeah, it's kind of like a Bigfoot, you know it's out there.
Yeah, it's there. You don't know till you go.
Yeah.
So yeah, man, I'm just out here chilling with the arepas.
Nice. Good.
Yeah, if anybody doesn't know what that is, it's basically like a kind of a corn tortilla, but smaller and thicker and kind of moist.
It's the Colombian. Okay, every country has their version of the Hot Pocket, right?
Right, exactly.
Okay, it's the Colombian version of the Hot Pocket.
Yeah,
right.
You can make a sandwich out of it, put cheese in it. You can, it's
very Mexico's
versatile.
Got the what do they call it? Like a torta,
Torta, soapy. They got soapies and corn tortillas, of course. Yeah.
So,
yes.
Let's see.
Same but different.
What's the one that does pupusas? Is that El Salvador?
Oh, yeah, like Guatemala or El Salvador. I
think it's El Salvador. I've literally been there and I can't remember the country. I think it was El Salvador.
You've just been to too many places, Steve. That's the problem.
That's a first world problem, Dan.
Yeah, I know.
Yeah.
I've been to so many places I stopped taking pictures.
Oh, that's great. Oh, I feel like we're hiding the lead here.
Yes.
Jordan Roy-Byrne. I found him, I believe, on Twitter and then started reading his articles, listening to his podcast, and I was like, wow, this guy knows a lot about gold. And, we just talked last week about the Roth IRA, and a billionaire hedge fund manager recommended that 7.5% of your Roth portfolio is in gold. This kind of goes along with the show. I've been kind of fascinated by it, getting some gold coins, and I might be into getting some silver too. I don't know. I'm curious. There's
ETF stocks as well. So after reading Jordan's material, I just realized how much I didn't know.
Yeah. You can get it in ETF stocks. You can invest in small mining companies, which we talked about before from James Rickards' books. Finding a mining company. Well, that's kind of what Jordan does. I was like, wow,
that seems to be his bag. So
yeah. So the universe just drops stuff in front of you that
we manifested
nuggets.
Jordan.
Pardon the pun. So I'm really excited about this interview. Super stoked. But so how's everything down in the booth? Did you guys move or go on a little vacation or something?
No, we're about to go. I'm going to be heading out to Cartagena. So so I'm just trying to get my girl to get COVID. So quote unquote leave for her work so we can get out of here.
Yeah. Get her that little check mark on she was exposed to the vid, and then it's a 2-week.
Exactly.
Okay.
Exactly.
Nice.
I'll be down in the Caribbean beaches there for a bit and hanging out. So I don't know.
Do you have a place yet in Cartagena?
Looking at a couple places right now, but there's so much available. So it's like it's just not a whole lot of people. You know what I mean? Comparatively speaking to like usual. So there's it's kind of pretty much get whatever you want.
What are you getting? Are you gonna get like an apartment or?
I'm thinking just like Airbnb on the beach, or it's all very Cartagena is very reasonably priced as far as like Airbnbs, hotels. So it's kind of a free for all. Everything's available right now, so it's pretty easy. It's just kind of like book it and set it.
I was there with Joe and Juliana maybe 4 years ago. No, it's been longer than that. It's been probably 6 or 8 years ago. and it was a lot of fun. We rented a little penthouse up on the top apartment, and it was like, $80 a night or something.
Yeah,
And, we're right on the beach. They've got let me see. Cartagena is the one with the big castle, right?
Yeah, it's a port city, old Spanish stuff.
Yeah, there's a neat little castle there with apparently some badass. They got a statue of him in bronze or something up on top, and he's got like one arm and one leg and one eye, and he's holding a sword, and like he defended this place. And it's a neat story that is worth a afternoon. It was,
cool. Yeah. So just out here, fixing up the grill. We got it all patched up.
Yes.
So
how's the dientes?
Yeah, the dientes. Yeah. It's all good, man. Yeah. If anybody needs any grill fixing, Colombia is actually. I mean, I have a fantastic dentist down here. So I even our friend Lot, he came down during this time and he completely fixed his whole grill up for literally like pennies on the dollar. So it was great. Got some great dental down here. If anybody needs anything, just hit us up. We can set you up pretty easy. Even medical translator if you need. Not a big deal. Easy.
If you need some serious dental work, don't do it in the U.S. unless you have just amazing insurance, because down there it's just so...
Well, just to give an example, I probably $15,000 worth of work for about $1,000.
Wow.
Yeah. So, I mean, you can really, I mean, obviously you got to go to a good person and So, but I'm pretty comfortable, giving a shout out about, who I went to and everything. So if anybody wants any information on that, no problem. Hit us up. Got to fix your teeth up, but stuff gets expensive, man. Root canal's a couple grand, at least.
Yeah. Pro tip.
Yeah. Pro tip. Absolutely, man. Yeah. So everything's good down here. Just hanging out in the book. Just went out to the countryside, hanging out with the horses, eating some arepas. Yeah, we're all good, man. We're just chilling. No children's on iPads, and they're
no eye sitters, huh?
Yeah, there's no eye sitters out here. Who are the Kardashians? It's kind of nice.
Right on. You were telling me that Aunt Jemima is alive and thriving.
Oh yeah. Aunt Jemima down here is just for all you cancel culture peeps out there. I just want you to know that Aunt Jemima is doing very well down here. Okay. She just got some new commercials, so she's kicking it real well.
Right on.
In the States, what would they change that to? Pearl?
It was something ridiculous. I heard something stupid yesterday from the fireman. I don't really watch the news unless it has to do with like stocks, but. They were telling me that Dr. Seuss is now deemed racist.
Yeah.
Is that accurate?
Yeah, Pepe Le Pew as well. It's Pepe Le Pew.
Pepe Le Pew?
Yeah, Pepe Le Pew's he's a rapist.
He's a rapist now.
Yeah, he's a rapist.
Oh, so now it's right. Okay.
I didn't know that.
I didn't either. This is news
growing up that he was actually like, that he was raping people, I guess, or wanted to, or I don't know what it is, man. I can't get with the program, but
well, that stinks.
Yeah, I know. Yeah. So don't watch Pepe Le Pew, but hey, like your video games are doing great, What does that mean? Hey, good on you.
This whole time, one fish, two fish, red fish, blue fish was just
jeez,
racist asshole.
Yeah, I know. Well, it's funny down here. It's like Latin America, right? What do we do? It's like someone's fat. They're like, "Hey, gordito," and it's like, and they'll smile at you.
Oh yeah,
it's like it's endearing. What were we saying? We should just start calling people by food ingredients.
Yeah, down there for black people, they say negritos.
Yeah,
it's just what. Yeah, they call us gringos.
Yeah, like,
and
hey,
it's
whitey.
Not like hey whitey.
Yeah, hey whitey, what's up?
Gordito.
Like, hey, or blanqui, or if someone's white, they call them blanquito.
Blanquito.
Yeah, it's like, hey, and it's like they'll smile at you, call somebody whitey or blackie. I'm just wanting somebody to call me like canela. Cinnamon in Spanish. Hey, canela. Hey, what's up? I don't think there's anything wrong with that. Come here,
Wonder
Camilla. Yeah, dude, start calling you, Weber bread.
Weber? Wonder bread?
Yo, Wonder. Yes, I know. I think we put too much emphasis on everything has to do with race in America, I guess, right?
I think so too. It's just getting ridiculous.
Yeah, it's just getting crazy. Yeah, I mean, I kind of like it here where they just, we just call everybody calls each other by like ingredients. Just keep it that way. Choco.
Yeah, what traveling does is things like that, and it just shows you that, to be a lot more appreciative for what you got.
Yeah,
and especially
absolutely.
if you're in the U.S., which most of our listeners are first world countries, that like, when you see a family of 5 on a little Vespa,
yeah,
you're like,
well, I don't even know if
wow.
it's a Vespa. It's more like a what is it, like a 50cc motorbike?
Yeah, exactly. I mean, it's a couple steps up from a lawnmower. I'll never forget. I was in Thailand and Bangkok, and I saw a dad, the mom, and little boy standing in front of the dad, like holding onto the handlebars. Then sister was riding behind mom, and then mom was holding a baby.
Yeah.
Like,
oh yeah,
wow.
that's here too. Oh yeah, I got that. That's all. You got that here in spades, man. You know what I mean? You're
Okay,
like, dude,
yeah,
wow.
yeah.
Like I'm looking over and I'm like, you're really holding a baby on a motorcycle.
Yeah.
Oh, that's like an everyday thing, man. I'm like, people don't know what poor is, man. I'm telling you, man.
I remember
Go to the Ukraine during wintertime, then you'll see,
I remember after my first trip to Thailand and seeing that, I went on a call in Oxnard as a fireman. This was probably 10 years ago, and it was a woman from Thailand who was holding her baby while she was driving a car, and my captain at the time was so pissed, and I'm like, he doesn't have the perspective.
Yeah, you're like, hey, that's normal. Like, dude, don't just chill. We just got to explain this shit to her. Yeah,
we just got to explain it to her. Like, you're in America now. We need to go down and buy.
You don't have a dirt floor anymore. It's all good.
Yeah, you've graduated from a motorbike to a.
I mean, we don't have government cheese anymore, but hey.
Yeah, there's probably a program out there where you can get a car seat for free.
Yeah, hey, man, I'm a product of government cheese. Hell yeah.
Those big old blocks.
Yeah, well, it's more like a brick, right? I think it's to smuggle drugs in it or something. I don't know how that you get away. Like, who is making that shit anyways, right? Like government cheese, dude.
It wasn't good. It wasn't.
Yeah, it wasn't good. It's like you have to mix it with some stuff, right?
Yeah, we've come a long way, dude. Like when you look back, it's
government cheese and purple drink.
Yep.
Hell yeah, my kneesy.
You don't need to say the drink. The drink is implied. Purple. Just say purple, red, orange.
Loving it. Yeah, hell yeah. Yeah, but yeah, so everything's cool out here. The one thing out here that I actually really like is when I step into an elevator, there's no awkward elevator moments here.
You know what? There's something to that. You're right. Yeah. Yeah.
Yeah, like you get into an elevator here, everybody's like, hello, how are you? And that's it. And you get off the elevator and like, see you soon. That's it. It's not awkward.
Yes. In America, it's like as soon as the door closes, it's just silent.
Yeah. It's like, oh my God. It's like sweating. Oh my God. Did I eat too much spicy
nervously
food?
Looking at their feet, There's some of the elevators that are kind of shiny, you can catch someone else's eye for a fraction of a second, but as soon as you do, it's just to look away as if it, it didn't happen.
Elevators are like awkward in America.
Yeah. But you're right. In Colombia, they're not.
No, not at all. It's very like mandatory. Like, you just say hi, it's not like Trader Joe's and asking me what the hell you're going to do with my goddamn day. Yeah. But just say hello. And goodbye.
Goodbye.
It's very pleasant.
Yes. Cool. Well, I'm excited about Jordan. This is going to be neat. I'm curious about the bars, coins, and then I want to kind of delve into a little bit about him finding the mining companies, because he gives out a general outline in his book. Which we'll put a link to in the
we'll see if he talks about some of the junior mining companies as opposed to the seniors, and not being confused with junior mining companies and exploration companies as well. So he should have some pretty interesting information for a lot of people, I think, even obviously us as well.
Yeah. And the thing about these things is it's like they're more risky, but your upside is a lot higher.
Well, I think he has a really good common sense approach from everything that I was reading, which is really along the lines of, just only a couple % of your bankroll with a certain amount of the actual, junior mining companies, or, it's just another play, it's just another, piece of the portfolio. So it's, it's another alternative. But I think it's actually, from everything that, I've been reading his book, I think it's a great way, just something to make a part of your portfolio. It's, I think it's almost invaluable.
I think so too. I think this is a great, 10 to 20 year bet,
Yeah.
You got to accept it's tied up, and you got to ride it out. But if the patterns that he's put together and what Daniel and I learned from Randall, like this is like a swing trade on a decade or more of time. You know what I mean?
Yeah.
Like,
I mean, it could be 5 years. I mean, it could be 60.
It could, it could be 10. It could be 20, but I think most of the people that are listening to this will be around 20 years from now. And if you don't make this bet, this is the same thing as when I bet $450, 9 years ago on Bitcoin and got one of them. You know, it's the same thing. I don't think that it's going to be that,
right. But you're looking at
but that's the kind of pattern that you're looking at, I believe.
You're looking at it, and just even, I'm sure he's going to have a lot more information on this, obviously, but it sounds like the valuations, we're at a point in time where valuations on precious metals, especially gold, is really good right now. It's kind of like
supply is limited.
Free money. What's that?
Supply is limited. There's a lot of mining companies that it's only been putting out like 3,000 tons a year, for years, and increasing that production takes time. And limited supply equals increased prices.
Maybe we can make Jordan our resident gold guy.
Ooh,
yeah,
I like the sound of that.
Yeah, resident gold guy Jordan. I like it. So
yes,
I'll have to see what's up.
Right on. Cool. Well, let's take a quick break and then we'll bring in Jordan.
I got supersonic speed that I used to run to you. I stretched my arms for miles and miles and wrapped them all in.
Hey, what's up, Jordan? How you doing, brother?
I'm good. How are you guys?
Awesome, man.
Awesome. Thank you for coming on the show.
Yeah, excited to have you.
My pleasure.
Yes. We kind of like to start with all our guests, if you could just kind of give us tell us your story, maybe in a couple of minutes, from when you started as a kid until, the success that you've seen today, as far as gold. Like, when did you first come in contact and become interested in precious metals and like that?
Sure. I started following stocks when I was pretty young in the late 90s and obviously didn't know anything. I got into the tech bubble early enough that I still made money. The problem was where I lost money was I was buying things on the way down, thinking these were great buys. And then when that didn't work, I realized that there had to be another way to really understand the markets and explain the price action. And so at that point, I started learning about technical analysis. And then I had a few people who told me about gold, and I was still kind of a tech stock bull. And so this was probably 2001.
Okay.
And I didn't, at that point, I obviously didn't know anything, and I still was averse to gold. However, a couple years later, I probably want to say 2003, I finally understood okay, there's going to be a commodity bull market. And I started investing in energy because it was easier to understand. I mean, the companies make money, but I knew I wanted to go into gold at some point. And so I kind of got lucky. I went in right before 2005 when it made that huge move. So
nice bet.
Kind of.
Yeah. Very good bet.
Yeah. You get lucky sometimes. And
I can relate to that. Yeah.
Yeah. So that's kind of what I've invested in ever since. And when I started investing in gold and silver, I was investing in just the producers, the smaller production companies. And I was just looking for small companies that were increasing their production.
Were these like juniors, Jordan? Like
Yeah,
junior minor? Yeah. I read your book, so yeah.
Yeah, we read your book.
Yeah, I just wanted to mention real quick, Jordan. I was like, oh my god, I actually got to read. It's not an Audible.
Yeah, and he's coming on in like 36 hours. Okay.
Well, actually, I'm sorry because I am going to do like a little bit of an update to the book, but I'm going to put it all on YouTube.
Oh, cool.
So people actually won't have to read.
Yeah,
Okay.
well,
I was going to ask you if you could do Audible. You should sell an Audible version of it.
Yeah, I mean, do you think it's current enough? Because like the first one I wrote in 2015, I had to completely change that.
I think you should just update it, and put it out, and then put a timestamp of April 7th or whenever you get it out, and But when I retrace your logic behind your book, I can see it. You know what I mean? Like the time I followed the graph back to when you made those bets, and I'm like,
yep.
As a technical trader, I recognize, and I'm like, wow, I wish I would have been paying attention to this at that time.
We're both in the same boat on that one.
Yeah. Just do it again for, an updated version. That's it.
Yeah. And, I thought all the information was very relative. I thought it was pretty easy to understand, but again, we do technical trading as well. So, I thought it was really good personally.
I did too. Yeah, man. Maybe we should differentiate real quick between that. So technical trading is, what to the listener, what Randall taught Daniel and I, looking at the graphs, picking the right time like that. And then there's fundamental trading, which is looking into, the financials and making sure this company isn't
worth their salt.
Yeah. So what do you put a little more pressure on, or is it 50-50 for you, like as far as fundamentals and technical?
I would say it's 50-50. I try and someone taught me 15 years ago or so. I mean, great technical analyst, and he said, but I always try and match the two, like technicals and fundamentals. So like what I cover in my service, I mean, I do like a lot of macro technical work, but then with the smaller junior companies, I focus on the fundamentals, obviously. But one thing about juniors, like I will say this, like it's pretty interesting because for a Canadian audience or like Australian audience, if you're talking about juniors, like they think of that as like companies with under a 50 million market cap. Whereas if you're in the US, you look at the GDXJ, a junior can be something that has like a 500 million or 700 million market cap. So I wanted
clarification.
Yeah, I wanted to clarify. So it really, I mean, a junior could be something that has a 10 million market cap, but also something that has like a 900 million market cap. So
just to clarify here, Daniel and I, like if you can picture us as the two kids in the short bus licking the windows with the stickers on our helmets. Okay, the GDXJ is an ETF, so like a stock that our listeners could buy that has a lot of these junior companies in it, correct?
Correct, but they're really on the larger side, to be honest.
Okay,
like
you're saying they're not typically your 50 million. You're saying they could be as high as 700.
Yeah, I think a couple of companies in that index have like $1 billion market cap. So
wow. Okay.
Yeah, it doesn't.
Wow.
It doesn't. And actually some companies that are in there are not. They're not really juniors. So one Canadian guy he did call the GDXJ the senior juniors.
Oh, the senior junior. Okay, well,
which is
interesting.
So I mean, I think I probably own a few things that are at the bottom of GDXJ. I'm trying to find. There's nothing. I mean, I'm trying. One sweet spot is I look for companies that are maybe they have a market cap of 100 or 200 million, and I think they have the ingredients to like become $1 billion company. So I like to look for what are the companies that are going to like go into the GDXJ eventually. So it's a little GDXJ itself is a little safer than what I do, but it's fine for for people who are new to the sector. It's fine to follow, but it is kind of it's a little bit more safer, and the companies are more established.
Okay. Well, I noticed, Jordan, you had a really good approach. I mean, we kind of take this approach, and in your book, and you explain, only putting a couple percent of your bankroll, into those juniors and spreading them out. And, when they lose, when they go kind of below that 20% line and just kind of kicking out of it as your kind of stop loss, on the companies as well.
Yeah. I mean, you have to have some kind of,
Bankroll management.
yeah,
Yep.
exactly. I mean, you have to have, I was going to say, stop loss,
Okay.
for lack of a better word, because these stocks, if you buy them at the wrong time, I mean, you can be down 40 or 50%. I mean, for example, people could have bought things last summer near the peak. And I mean, even like the high quality juniors that I like were down like 30 or 35%. So there's even stuff with decent quality that was down 50%.
Oh, okay.
So that's why
yeah.
people have to be careful, because you can have a bad entry point. And if you're down, if you lose 20% on a position, there's greater odds it's going to become 40, 50%. And then if that happens, you could be down 60 or 70%. So people have that is extremely important, and preventing big losses, because sometimes investors who don't have a lot of experience, they'll be down 70% on something thinking it's going to come back in 5 years or 2 or 3 years. And it's, maybe it will, but you're so far down that it needs to, you need to do 3x or 4x just to get back to even.
Right.
Yeah.
No, we can't have that. We have to cut our losses.
Yeah.
Okay. I like your formula a lot. You say that you bet 5% of your bankroll on one of these companies, and then you set a stop loss at 20%. So the most you're going to lose on that bet is 1% of your total bankroll. It goes right in line with what Randall taught us as far as day trading. Is you bet 10% of your roll on one bet, and you put the stop loss at 10%. So it's still you're never going to lose more than 1% of your roll.
Right. Yeah. Yeah. I mean, in investing in this sector, you do have to have more of a trading mindset. Now I look at things as 2-year holds. Maybe some are a 3-year hold or some are a 1-year hold, but you really have to have a trading mindset to be successful, unless you're just some whale and you're putting you're just putting tons of money in. It doesn't matter. You'll just wait 3 years, and it doesn't matter if it goes down 70%. But if unfortunately that's not you have to have a trading mindset to be successful.
It's professional gambling.
Yeah, no, it really is. It really is.
Yeah.
No,
exactly.
I thought you're just, the whole book, just a real kind of common sense approach to it. And I thought it was really a good way to go about it, as having, at least part of your portfolio or part of the trading that you do. I thought it was really awesome.
Thank you. Yeah, it is very, very good. Okay, so the GDXJ, that's we'll do air quotes here, junior ones, and then the GDX, is that basically these juniors that are now established?
I would say the GDXJ. The GDX is more and it's unfortunate because there's numerous indexes for precious metals companies.
Okay.
But GDX. There's something called the HUI, the HUI. Have you heard of that?
No.
Okay, so that is an index that a lot of people would follow before the ETFs came about. I think the HUI goes back to 1996, and so that is basically the unhedged largest gold producers. And what's interesting about the GDX is I like to say the GDX is basically the HUI plus royalty companies. So the GDX, they've snuck in these stronger royalty companies, but it is, I think, the biggest ETF. So that's what I like to follow. And then you have the GDXJ, which is kind of you could say the more established, larger junior companies. I think the biggest companies in that are around $1 billion market cap. So the bulk of that are probably going to be 500 million to like 1.5, 1.3 billion in terms of market cap. And the GDXJ also has a little bit more, I should say it has some silver exposure. I think GDX doesn't really have any, but GDXJ, I mean, I'd have to look at it in detail, but it definitely has some silver exposure in there.
Okay. Yeah. Do they pay any kind of dividend, or is this just like straight growth?
Straight growth.
Okay. Okay.
If you want dividends, you got to go for the big caps like Newmont. And I think a few of those companies have actually raised their dividends recently. But yeah, for the juniors, it's all about growth.
Okay.
Yeah.
Okay. Now, looking at the technical chart right now of GDX, um, I'm actually kind of liking it. I feel like it could do this, or it could go down to, it's at $33 right now. It's kind of lining up pretty good with where it was in June of last year. Do you agree, or is this not something that sounds right?
I would say as long as it holds 31, as long
Okay.
as they can hold these recent lows, because I've been a little. I mean, they have corrected. I thought we were going to correct. They've corrected more than I've thought, and so I tend to be a little more cautious and conservative than my colleagues. But yeah, I'm a little disappointed at how far the correction went, and we'll just have to see if GDX can hold above 30 and 31, and if GDXJ can hold this recent low.
Okay.
So that's one thing I'm watching.
Okay. But either one of these in a, as far as like a 3 to 4 year bet, is probably going to be a winner, right?
I think so.
Yeah.
But I will say this, like if they have a huge move in 2 or 3 years, they could give a lot of it back in the 4th year, just because historically, even during bull markets, you can have like a 60% decline. Like if you look at gold stocks did really well from 1957 to 1980. Well, actually all the way to 1987.
Okay.
But from 57 to 80, I mean, I think 2 times in there you had like a 65% bear market.
Yeah.
So
Okay.
that's something people have to understand. Like, yes, they could make huge. That's why you say 4. I mean, if you say 5 years, I would say yes, but there's probably going to be like a 50 or 60% bear market after the huge move.
You got to be willing to get out.
Yes, you have to. Going back to risk management, you have to trim things on the way up. Not sell the whole thing, but sell pieces as it gradually rises.
Yeah. I want to hit on that. What is the formula that you use for trimming? And it's a lot of based on your prediction, right? If you think it's going to go to 300, or if it's going to go to like 100, 150%, or.
Yeah, I mean, I one, if you have a balanced portfolio, then I would say if it's more than 10%. So if I'm doing a lot of 5 or 6% positions and they grow to become 10%, then I start trimming it. So that's one way you can do it. Another way, I mean, depending on the size of the company, if it goes up 150 or 200%, depending on where the sector is, you could sell a third. I mean, if it's something that's more aggressive, and if it's something smaller and it goes up too much and it's not all fundamental based, you could sell a half. So you really have to do what works for you. But I just generally say like sell a third or sell a half. The other thing is and you have to be constantly following. But if it does, it makes such a huge move, but then it doesn't have as much upside like over the next year or two. Like I did have a couple things recently, like in January or February, that I probably should have trimmed, but I didn't. So that's another thing. And because I was thinking, oh, well, these are not 10%. That's fine. I don't need to trim them. But then thinking back, well, these things they made a huge move, so they don't have as much upside over the next year or 18 months. I should probably trim them.
Yeah.
So you have to, that's how I look at it. But people have to use that and figure out what works best for you.
Yeah.
Okay.
And you cover a bit of that in the book. So if anybody's, interested as well, I mean, you cover a bit and, how you do that. It's a portion of the book in there as well.
Yeah. Yeah. Okay. So those are GDX, GDXJ are indexes for mining companies. And GLD, is that like an ETF that they house the physical, like they physically have the gold, right? And then they break it down into smaller share prices, and it essentially follows the price of gold.
I don't know if it's one that like they may have claims on it or something. I'm not an expert in that. I know there's ETFs out there that actually are legitimately backed by gold. I don't think GLD is one of those.
Oh, okay.
Yeah,
Okay.
I think there's other ones that are better in that regard.
Really? Do you know what they are?
I think on silver, like PSLV is a real popular one. PSLV is the symbol.
Okay.
As far as I think, one that I think does have the metal is CEF, Cat Edward Frank.
Mm-hmm.
That now that is, I think it's like 50% silver and 50% gold. So it's not it's not like a pure. It has both in it.
Huh. Okay.
But I must confess, I don't spend a lot of time on the metal ETFs and which has the gold and which doesn't. It's just not my expertise.
Yeah, I like that. You've got it niched down so good.
Yeah, you really, you definitely have a niche,
Like,
Jordan.
man, he knows exactly his field.
Yeah. This is exactly what I do.
Yes, I love it.
Well, I mean, there's other people that can speak to that. On and then there's, I don't want to say conspiracy theories out there, but
oh no,
then you'll hear you'll just
The
hear
crazy gold people.
Yeah, you'll hear people talking about GLD, and it doesn't, well, I read the prospectus. It doesn't actually, have a claim on the gold. It doesn't have the gold. And so, there's people who argue about that.
Yeah,
So,
I know there's a lot of conspiracy theorist gold people out there, so it's kind of gold. It's kind of funny, because, a lot of people have an opinion on it,
Yeah. It's been interesting. I've only recently learned about it, and I've since got some gold coins, the bullion. What are your thoughts on having some percentage of your net worth, whatever that is, in bullion, and then and what do you think of like silver bars and stuff?
I think you have to look at physical. That's what we call it in the industry.
Yeah. Okay, there we go.
if you want the lingo, that's just one. Yeah,
Thank you.
Word.
Yes, I do. I
so
just put another sticker on my helmet right now.
Yeah, lick it, Steve. Lick it.
Physical. There we go. Okay.
Yeah. So physical is, I look at it as a form of financial insurance, honestly. So whatever you, 10% or 5% of your net worth. So consider it a financial insurance position.
Okay.
I don't look at it as something like that you're going to trade or sell.
Okay.
So that's how I look at physical. But it's
interesting.
Silver. I mean, the problem with silver is like it's so
heavy.
Well, it's like to have a lot of it.
Yeah.
Like if you're going to put even just like $10,000 in silver, I mean, that's like a shitload of bars compared
it's
to
so
gold.
heavy.
I know. I have a box.
Yeah,
it's I don't like picking it up.
Yeah, compared to gold, and then you just you just have like one, you just have a couple bars.
Yeah.
But I mean, I think it's like silver coin. Like if you really want to go down the rabbit hole, and you think we're going to be using physical as a form of legal tender, then I would get like silver coins.
Yeah. I guess what I'm asking is, like, do you think that as I was looking at the bullion until you mentioned that right now, I never thought of just keeping it forever. But I was looking at it as like a 10-year bet, for the bullion. Is that
a 10-year? I mean, Yeah.
Well,
I mean,
you want to trade it in at some point and make some money.
Yeah. That's what I was looking at it for.
Well, I mean, you can do that as long as if you have a place to store it and all that.
Okay. Yeah, that's one thing with the physical gold is
it's a pain in the ass.
Yeah.
Thank you, Jordan, for clarifying that, because it's a pain in the ass.
It
really is.
Yeah. No, I know. I got a bunch of silver, and I'm like, oh God, I got to open this goddamn box again.
Yeah. It's worth twice what you paid for it, though. Well done.
But it's so heavy. My God.
Yes. Oh, right on. Okay. As far as picking your junior mining companies, you gave a really neat graph in your book. I'm going to try to describe it here. It's kind of like two waves, where the second wave goes a little bit higher than the first wave, and it sounds like what you've studied and become good at is timing both of those. Do you like trim, ideally in an ideal world, if you pick this thing before the first wave, do you trim like half of it or something on the first one and then re-enter again on the second down?
Well, I will say this: not every junior perfectly follows that. I think it's called. You're referring to the life cycle of a junior miner.
Yes.
Chart.
Yeah.
So not every company will fit that life cycle, but generally, if we're talking about the life cycle, the two times you want to buy are in the months leading up to first production. So when they're towards the end, in the middle or towards the end of the construction of the mine period.
Yeah.
And so that's one time. And then the other time is if it's a company making a discovery and they're growing that discovery. I mean, it's like, I liken it to like you're a surfer and you're riding the wave, like you're trying to get on the wave early enough where there's still quite a bit of growth potential. And I mean, there's no, like that can, that entire wave of them drilling out and working on the discovery. I mean, that could be like 1 year. In some cases, it could be 5 years. So there's a lot of variation there, but you want to, like, what I try and do in that, with respect to exploration companies, is to kind of quantify it, because I like numbers.
Mm-hmm.
I try and find if they have, like, let's say they have 1 million ounces already or close to it. It looks pretty good. And I think there's potential to get to like 3 million or 4 million ounces. That's kind of how I want to play it. I want to look for things where they have a little bit of something so far. So, there's a defined value and backstop there, but at the same time, there is quite a bit of growth potential, because if you're looking at, in a lot of these companies, a lot of these juniors, I mean, there's many that, they're just starting up and they're really, they're 5 or 10 cents and they're just coming to the market. They don't really have anything. I mean, then those are a lot more risky, because they don't have anything really backstopping the company there.
Yeah.
Nothing to give you some momentum, I guess, when you're saying, hey, they got some ounces here, like, riding the wave here a little, right?
Right. Yeah. They haven't found the wave yet, so to speak.
Yeah. Right.
Yeah. Okay. When you, in your book, you talk about things you look for in finding these companies. You talk about capital structures, management, projects, having the right jurisdiction, insider and institutional ownership, value, and can you kind of give a brief summary of that? Like, how did you even find out? Did you learn these in school and you've kind of perfected them, or like where do you go?
No, although it would have been cool and interesting to go to like a real mining school, like Colorado School of the Mines. They actually have a football team.
Oh wow!
So, what?
So I guess, yeah, they do. So they have
awesome.
They have an athletics program.
They call the miners.
Probably. But no, UTEP, Texas El Paso. They're the miners, I think.
Okay. That would be hilarious. They got to be the frogs.
Looking at just through trial and error and experience. I mean, I didn't know anything in like 2005, 2006, and that's the other thing. We have to put our ego aside, and I mean, you guys know this in trading. It just, the market is always right. The market is the market. So when you're making money and doing really well, like, never confuse a bull market with brains.
Yeah.
So especially in this sector, like you think you're such a genius. You think you're such a genius, like making 3x and 5x on these juniors, and then suddenly there's like a 50% correction. It's you have to just understand, and you can do really well. Like, it's a bull market. I mean, that's how you make money. It's from riding the trend. But anyway, so that, I mean, that's a big thing I learned. But getting back to the criteria, it's just something I learned over time. And so looking at, like, if we're looking at a producer, like, I want to see management where they've built a mine before. So that helps a lot. Like, if they have,
if he's done it, he has.
Yeah,
he has
not like it's just a good idea to start.
He's not Gold Rush.
Hey, yo, I got a shovel.
Yeah, exactly. So, I mean, that helps a lot when guys have done it before and then they're setting out to do the same thing again. I really like that. And then as far as like the insider ownership, that's probably a bigger deal with smaller juniors that don't have that long of a history, because when they get bigger and they raise money a lot, they're ready to produce a serious mine and they're in the GDXJ. I mean, the management guys will have been, their ownership is going to be diluted down. So it's a bigger, it's proportionally inverse to, we could say like the age or how established the company is. So like if they're a tiny company that's near the beginning of their life cycle, you want to see more management ownership. However, this is interesting because there's all these different points. Mm-hmm. They could own a lot of it, but that's because they loaded themselves up with cheap stock.
Yeah.
So that's also how they can own a lot. So it's not all black and white. But institutional ownership, that's also important. Like you want to see, I mean, there's big there's big names in the sector who invest in other companies. And so, I mean, that's a good sign to see someone like that invested. So I want to see, you want to see the retail float generally be like 50% at the most. Okay. So then you have 50% of the stock is like insiders, management, or institutions. And I mean, these aren't hard rules. These are just general rules. And then the thing with share structure is, so these companies don't make money for the most part. And so they sell more shares. That's how they raise capital. Yeah. And so a lot of these companies will have bloated share structures, and in these financings, they offer warrants. So that can also be an issue where, I mean, maybe a company has like 150 million shares out, but they have 220 million warrants out. And then, the warrants are acting as like a cap on the stock in some cases. So that's important. And in getting back to, like I said, these rules aren't all hard rules. I mean, there's some companies that they have messed up share structures, but that's because it's taken them a few years to get to a point where they really have developed something that's really valuable. So you can't rule out, I don't know if this is contrary to what I wrote, but you can't always rule out a company if it just has a bad share structure. It's just kind of a general rule, because a lot of companies that actually have nice, clean share structures, they're relatively early in their life, and they haven't, haven't really defined that. They haven't defined something of real value.
Yeah, you haven't gotten to see any history.
Yeah.
Yeah. Okay. Yeah, that would make sense why that favors a little fundamentals there, because you don't have the technical side of it. One you mentioned in one of your free reports was Rio 2, as far as a company that, and these are high risk, but also high reward. It could go 5 or 10 X. When I looked it up, some of the stocks I buy are on Vanguard, and I was trying to find the ticker for it, and it was like there was a couple of different ones. What exchange are you using to get some of these junior mining companies?
They trade on the pink sheets or over the counter in the U.S. and but they trade the most volume in Canada. So the TSX Venture, I mean the regular TSX or the TSX Venture. So you really need to have I mean, you can still buy them, with a Ameritrade or a regular U.S. account,
like Fidelity or whatever.
Yeah, over the counter. But if you really want the best liquidity, it's best to use actually Fidelity or Interactive Brokers where you can trade. I mean, you can buy and sell them direct from Canada, or I mean, in Australia, because there's also another junior market, and so not all those companies will have a U.S. listing, even one on the pink sheets or the OTC. But yes, a lot of them have 5 in the U.S. They have 5 letter symbols.
Okay, yeah, because I tried to look them up and I ended up getting for Rio 2. I ended up getting, and the report is really cool. When you guys go to his website, the Daily Gold, look it up. It's six pages of Jordan basically breaking down this small junior mining company, and so anyways, the tickers I got were like RIO period V and then RIOFF, but they both have different time scales. Like one's been around a long time and the other one looks relatively new.
Well, the Rio.V, I think the V stands for the TSX Venture.
Oh, okay.
Like if you're looking it up on like stockcharts.com or I think Yahoo. That symbol works on there. I think, the former iteration of the company, I think its symbol was, I think it had the same symbol. So that could, if you're Rio 2, I think came about, I want to say 2017-ish. So all the stuff on the chart there pre 2017, that's a different company.
Okay. And then now it's using the same ticker for a new one.
Okay. Yeah.
Okay. That makes sense.
Yeah.
Okay. Huh. Right on. Cool. What else did I want to ask you about?
Yeah. So, Jordan, I just had a quick question for you, just for listeners out there, because it seemed to kind of get the gist from the book and everything. I thought it was good that that you seem to think just the valuation on gold, that it was it's a good time to buy gold, I guess, is what I'm trying to say. And for other people out there listening, what are your thoughts on just the average Joe guy, like wanting to buy some gold, just recommendation?
Well, I think they should get a lot of education on it.
Yeah.
First, one thing I will say to like just dumb it down for everyone, because like I've been thinking about this. Like, if you look at, we are like close to or approaching one of the worst times that you could buy stocks or bonds.
Thank you.
Thank you for saying that.
Thank you.
And that, I know that sounds really dramatic, but
yeah.
If you look at, what's interesting to me is if you're looking on a 12 or 13 year basis, if you go back to, so you have 1929 to 1942, and then you have 1969 to 1982. The 1969 or 1968 to 82, in terms of a 60-40 portfolio, that was worse than the Great Depression.
Okay,
so,
I heard you say that. What is the 60-40 portfolio? That was one of my questions.
60% stocks, 40% bonds.
Okay.
Just the traditional portfolio that the financial industry stuffs everyone into, basically.
I knew it was that, or it was the other way around. I wasn't sure if bonds was 60 and anyways. Okay, thank you.
And the trigger for that in the late 60s was the rate of inflation broke higher. It broke out of, so the CPI, it had like a mini breakout in 1965, and then late 68 or early 69, it broke out for, I think it was a 15-year breakout. You can also chart economic statistics, by the way. But so the CPI, it's obviously flawed. It's economic data is a lagging indicator, but my point is, when the rate of inflation broke out to like a new multi-decade high at the very end of the 1960s, that was the trigger for higher inflation, the market recognizing it, and your conventional investments just being a dumpster fire for people over the next decade plus a few years. I would say it again, the 68 to 82 period, it was worse for the conventional portfolio than 1929 to 1942. And, people are wondering, here and now, people are wondering, what's going to happen? are we going to be able to print money forever? And, the stock market's always going to go up, time in the market, blah, blah, blah. Looking at the CPI, it's been in like a 30-year downtrend since 1990. And so I'm thinking when we see
CPI
that.
is inflation.
Right.
The consumer price index.
Yeah. And by the way, I don't know if you've heard of shadow stats, but there is a guy who he tracks stats like the way the government calculated them like 50 years ago before they started screwing around with the numbers to make them look better. And I mean, the curves in a lot of his data are similar, like the trend in the curves and the CPI and other data points, like they're similar to the CPI and the other normal statistics. So it's really the direction that things are moving in. That's my point. But the CPI, if you go back to 1990, it's kind of been trending down for I mean, you can draw a line down in the CPI since 1990. It's hit it a couple, I think it went above it in 2008 briefly. But my point is, if we see the CPI, breaking above 3%, getting to 4%, I think that's going to be a similar trigger as what we saw in 1969. Because in other words, higher inflation, you start out and you get a little inflation.
Right.
It's still, okay. But once it starts moving higher and people recognize that, I mean, it's bad for businesses.
Right.
It's bad for consumers. And it's a terrible environment for stocks. I mean, you have people out there. See, here's the thing. Stocks disinflation, which is inflation, but the long-term trend is going down. That is good for stocks. That's really bad for gold. It's good for stocks. That's what we've had for a really long time. However, when you start to see rising inflation and we break out of that 30-year downtrend and we get 3-4% CPI, that's going to be look, I mean, the Fed is going to have to do yield curve control. They're not going to be able to let long-term interest rates rise. They're going to have to cap those like they did in the 1940s because there's too much debt out there. And that's when we're going to see the stock market really struggle. You'll see inflation rise, and you're going to see like gold and other hard assets like really explode. As far as the timing on that, I don't know, but I'd say in the next couple of years, that'd be my guess. It might be in 6 months, it might be in 2 or 3 years. I don't know, but it's definitely coming, and that because it's important for people to understand the fundamental macro picture, and because if you understand that, you can get a sense of how and why things are moving. And I know that people say, well, the why doesn't really matter, but I mean, I think it's nice to at least for traders to at least have some knowledge and have a fundamental macro idea of what's going on and why these markets might move in a certain direction.
Yeah, I think your book covered that really well, Jordan. Talking about those kind of inverse relationships and stocks and gold, and I thought it was explained really well. I mean, I understood it. It was pretty easy to understand. So, but my question, I got a question for you. I mean, do you do gold? Do you do silver? Do you do other precious metals as well?
No, I do. I do have a service which is for private placement. So that's even like, to use a baseball analogy, in my portfolio in the regular service, I'm looking for home runs, but the private placement service, I'm looking for grand slams. And we did invest in a rare earths company. So that's one kind of opaque industry that's part of commodities that we did invest in that service. So I think other commodities are going to do really well as well. I mean, it's interesting because usually gold moves first, and then you see silver, and then you see the other commodities, and that's at least what's happened since the COVID crash last March, where you had gold move first, silver follow. Now all these other commodities have been doing really well, while gold has been correcting. So.
Yeah, Daniel and I have we've been buying oil since the crash of COVID. What do you like oil? Do you like what other commodities do you like?
The interesting thing about oil, I at some point in the last year, like I saw some charts on that pointed out, I think like energy stocks relative to the S&P were like the cheapest they were. Yeah. I want to say in like 100 years.
Yeah, they were. Yeah,
oh,
they were. Yeah,
okay,
pretty close.
So Yeah, I remember seeing some data on that. And I mean, it's interesting because in like 2015, the gold stocks were basically the cheapest in like at least 100 years. I mean, I could, like, you've seen it in the book. Like it's hard to find data going back that far, but like everything I was looking at, I was thinking to myself, geez, like this is the cheapest the sector's ever been.
Yeah, you were saying the valuation in the book, the valuation on the gold was just really good. So at this point in time,
and one thing I like doing with charting is like I compare. You guys probably do this as traders, but I compare how one sector is doing to another. And I mean, just look at the gold to the S&P or even the GDX to the S&P charts. I mean, in the last article I wrote, like the bull market has barely even started yet.
Yeah,
I mean, if you look at those ratios, I mean, they're setting up for a huge move higher as far as gold and gold stocks relative to the stock market. Now, it's not imminent. It's probably not. It may not start this year, but that's. Right. I mean, when you see those ratios break to 7 or 8 year highs, I mean, that's going to reflect capital starting to move out of the stock market and into gold and other hard assets. And so it hasn't. I mean, like the looking at that, I mean, the bull market has barely even started.
Yeah. And I noticed you also said we had a little, and I saw the charts and everything as well. We had this little, I think it was, don't quote me exactly, it was like 2018 or maybe 16, 18. It looked like it was kind of creeping up, and then, it didn't quite do the bull market thing. So we're still in line, according to your dad and everything. And you talk about in your book that we're in alignment for a coming bull market in gold, basically, just for our listeners to know.
Yeah. I mean, it's been the last like 4 years has been interesting because we've had obviously gold, it bottomed, it made a new high. I mean, it's, in my opinion, I mean, the chart pattern is super bullish. It's just, it has a huge cup and handle pattern, and it's building the handle right now. And the fact that gold, the fact that the right side of the cup was higher, that it was able to get to almost 2,100 versus the 2011 high at 1,900. I mean, the fact that happened is a signal of more strength. And now it's just building the handle off that pattern. And in my opinion, will eventually explode out of that. But yeah, it's just been interesting the last 4 years since the 2016 low, because you've had moves in like bits and pieces.
Yeah.
So it's just found resistance, I guess, from a trading perspective, or like it keeps finding some resistance and hasn't busted through a moving average yet, right?
Yeah, yeah, and so it's been and so like reflecting that back to like the riskier stocks. So it's been tough for them because there hasn't been like a full like year or 2 year run where like it's really trended strongly without much interruption. Right. And so I think the next move we're probably going to see something more like that versus what we've had, which has kind of been, gold's done well. It doubled in 4 years, but it's kind of been a choppy
way there.
It has been pretty choppy. And so if you look at the charts of a lot of these junior companies, like the whole industry has not had a huge amount of success, even though, gold has made a huge move higher and silver has made a decent move.
Yeah. Yeah. What moving averages do you look at in gold, and what time frames? You mentioned 200 and 400 in your book. What do you look at that on a weekly or monthly, or do you put those moving averages on all timetables?
Daily
is the main one.
Yeah, for short-term trading, I would just use the 20-day and the 50-day.
Okay.
Got it.
And so for more general trend, I like using the 200-day and the 400-day. I actually did a study. There's an international master's program for technical analysis. So to get that designation, I wrote a paper on the 400-day moving average. So I looked at a study and I studied various markets, and that's actually a better sell signal than anything else.
Interesting. For gold, or do you find that
just
for all these?
I'd have to go back and look at the data, but I was looking at gold, oil, and various stock markets over the last 50, 60 years that, it turned out. And so I think I was looking at monthly data because there would have been too many signals. So on a monthly chart, it's the I think that's equivalent to the 20-month. So on a monthly chart, I like looking at the 20-month and the 40-month, but that's a really long period. But yeah, and so on the weekly, I look at whatever is the equivalent to 200-day and 400-day. You know, you could use like a 42-day or a 50-day or an 80-day or a week, I should say. But yeah, 200-day and 400-day, that's kind of my bread and butter.
Okay.
Oh,
Okay.
Interesting. No, that's cool. Very cool.
Interesting. Yeah. I'm curious to translate those across some of the other stocks that Daniel and I have invested in and see, because there's random things that don't seem to like follow each other, or it seems like they should follow each other, but they do. You know, like we found a correlation between banks and what sector was it, Daniel? Was it energy? It
Energy
was
sector, yeah.
Yeah, it was kind of strange, but yeah, I'm curious to try that one. That's kind of cool. I got one more question on bonds. So we got bond prices and interest rates and yields. Can you kind of do a quick 101 on that and its relation to gold?
Okay, well, the fundamental driver for gold is real interest rates, and so gold is inversely correlated and so we have to think of gold as money, because it has been for 5,000 years, because it was the best form of money. It fit all the properties of money. So that's like a way back history on gold. And so it moves based on real interest rates. And so think about it like this. If you can get, 6% on your money in the bank, and there's only like 2 or 3% inflation, you're earning a real return on your money. So in that environment, like we had for most of the 80s and 90s, gold is worthless, or it's not really moving. And so that's basically, based on that, the driver of gold going higher is you either have aggressive rate cuts, falling interest rates, or accelerating inflation. So moving forward, it's probably going to have to be accelerating inflation. But recently, in recent years, it has moved more so on the rate cuts or the falling interest rates. And so when inflation statistically is pretty low and not moving, it's going to be, the moves in nominal rates and yields are going to play a bigger role. And so the reason why gold has sold off is because it made a huge move based on the Fed cut rates. So around the world, bond yields were going lower. You had some went negative. So you had zero rates, and weirdly enough, you didn't really have fears of inflation, maybe a little bit, but rates were low. They were not moving higher. So that's why capital moved into gold. So even and the reason why capital is moving to other places now is because you've seen a reversal of that trade. And so even though like in the very big picture, it's positive for gold, like this reflation, higher inflation expectations, yes, that's good for gold. But the problem is bond yields have risen. They've risen so much recently that real interest rates have not declined. And so gold needs real interest rates to decline. So real bond yields have risen, at least in the last 8 months or so. They've risen more so than, I guess, fears of inflation, or they've risen more so than the statistics of inflation. So that has pushed, I know real interest rates they haven't gone up they've only gone up a little bit, but I think the market is kind of discounting. It thinks real interest rates are going to move higher, at least in the short term. So when you're in an environment where inflation isn't really accelerating, or inflation expectations haven't really accelerated yet, in that environment, when you see higher yields, that is going to hurt gold a little bit. But at some point, if yields keep moving higher, at some point, it's going to be bullish for gold, because inflation expectations will at some point accelerate. And also, given the debt that we have, the Federal Reserve is going to come in and say, well, we need to cap these yields like we did in the 1940s, because there's just too much debt. We
too
can't
much debt out there.
Yeah,
right?
we can't. We can't have bond yields at 3, 4, 5%.
Yeah.
And what people have to look out for is, if we do have, gold, it will still do well with accelerating inflation. I mean, because this happened in the 1970s. And so the mainstream people who don't like gold, what they will say when the Fed starts hiking, they'll say, that's it for gold. You know, the Fed's hiking, gold's done. However, that we know that the Fed is only going to hike rates when inflation really starts to accelerate. So if we see inflation get to 3%, you know, they'll talk about, we're probably going to start hiking soon. It's 3.5%, 4%. They do a few hikes. I mean, that they're hiking the rate of when inflation increases, which I think it will, it's going to increase faster than the Fed will do its rate hikes. And so that's what happened in the 70s. So that's what people that's what people have to look out for fundamentally, because the knee-jerk reaction for mainstream financial people will be the Fed's going to hike rates, you know, gold is done. But no, that's not going to be the case.
Yeah, I agree. I think
you make a really solid case about all this, and I mean, I'm pretty privy to getting some more gold myself. So
yeah, this has been awesome. Thank you, Jordan. So you can check out Jordan's website, The Daily Gold, and you have a subscription for 6 months, basically inside access to you vetting a lot of these companies, correct?
Correct. And I have a free newsletter there, which you can get. So
I've already signed up for it.
Yeah, we're already on that, Jordan, man. We got
we've read your book. We
got you.
It's been 36 hours. We're in.
Yeah. So, so we're gonna put a link out as well, Steve, for him as well, and see if if he's interested, and learning more, and especially about these junior companies, it's very interesting stuff. So
it is. I'm fascinated by that. I think I could go down a rabbit hole here and just enjoy the shit out of myself. Pretty cool. Yeah, thank you, Jordan.
Yeah, appreciate it, Jordan. Yeah, thanks again.
Yeah,
my pleasure. I really enjoyed it.
So did we.
Yeah, we're gonna have you on again if you don't mind, man. We got to break down some more. You have a lot of information, man.
Oh my God, yeah. I think I have more questions now than answers.
Yeah, I got more questions than answers, man.
Well, if you want, I'm still here. So if you have one or two more.
I don't know if you have a hard break. I need to do research and gather my thoughts. And, we were joking before that maybe you'll be our resident gold expert. We'll bring you on every little bit and get your opinion.
Yeah, no, I'd be happy to come on anytime.
Thank you, sir.
I got supersonic speed that I used to run to you. I stretched my arms for miles.
Wow, that was a lot of info. I think Jordan has probably forgotten more about gold than Daniel and I know. I'm recording this a couple of days after we had Jordan on. Wanted to give you guys a little update. Before I forget, Alex and Dan have signed up for Randall's options trading course. So excited about that. Alex is going way through the program, and Dan is going to go through it with his son. So that's a pretty neat father-son project there to start trading options. Pretty neat. Be sure to check out Jordan's number one stock pick. It's a company called Rio 2. He puts out a quick, easy to read, it's a little 6-page summary of it and why he believes that it's going to be a great investment for a junior gold mining company. The president and CEO is Alex Black. And after I read Jordan's report, I figured it was worth throwing a dart at the dartboard, and it hit. Alex Black is going to come on the show 2 weeks from now. So we will have a president and CEO of a junior gold mining company. We can pick his brain and just find out more about gold. Talk to a gold miner. If you guys have any questions for him, be sure to hit me up, stevebartonmoney@gmail.com, and we will ask him. Let's see. The company, you guys can look it up yourself, is rio2.com. So that's RIO, the number 2.com. And you can look into their all their details and everything. They're about 2 years from actually being able to mine the gold. But they're getting all set up. They're getting water out there. And it's kind of neat. Pretty exciting. Another thing is all this talk about gold. when you guys go to buy gold, if you're going to buy some, stick to 1 ounce and above. If you start buying it in grams, the spread is pretty high. So the spread is basically what the coin dealer or the website is going to charge you to purchase it. But the bigger amounts that you get it in, the lower the spread is. So if this were poker, it would be the rake or the vig. But in gold, we call that spread. So there's 3 types of gold coins that you want to stick to. They come in 1 ounce varieties. You want to stick to the South African Krugerrand, the American Liberty, or the Canadian Maple Leaf. And the reason we want to stick to those 3 is because when you go to turn these in 5 or 10 years from now, they're very easily identifiable. Any coin dealer is going to instantly be able to look at that, know that it's real gold, not have to, if you go and start buying these little bars and stuff from obscure mints, you could run into trouble, and the ease of transaction is going to be either not there or more difficult. But if you stick to these 3, you can be very certain that when you go to turn these in years later, it's everything's going to be on the up and up. I would avoid buying silver in 1 ounce varieties. I would stick to bigger bars. I got a 100 ounce bar of silver as to be able to play a little bit of that game. What we can also do is we can play the stock game with gold and silver. So like we did with our Roth IRA buying GLD, we can play the gold market that way as well. That way you don't have to physically store this stuff. But I think it is good to have a certain amount of your portfolio in physical gold. The one that I recommended for, I've since learned, the one that I recommended for the Roth IRA, the GLD ticker, that apparently is paper gold. So they do have physical gold, but you can't access it. Okay? So essentially they're trading gold futures, paper gold. There are other companies, and Daniel and I will go on and talk about some more of them. I'll give you a couple of them right now. One is CEF, Charlie Echo Foxtrot, which is what Jordan was talking about. There's another one called OUNZ, and both of these companies trade in physical gold. So you can buy stock in this company and then sell stock in the company. And if you really wanted to, you could call them up and get a physical ounce or however many you wanted mailed to you. Now, I don't recommend doing that because there's some tax implications, and I'm sure that you could go down to your local coin store and pay for an ounce of gold that's a lot cheaper than having them go through converting stock for you into physical gold and then mailing it to you. But the point is that you can do it. And there has been a point in history in early, it was right around when the coronavirus hit. Gold went up pretty quick, and these physical gold companies were trading for about $80 more per ounce than the GLD was, than the paper stock companies. So if there comes a time when gold is going up and skyrocketing in value, then these companies that trade in physical gold are going to be worth more than the ones that aren't. So I'm really questioning that recommendation about, the 7.5% of your Roth IRA should be in gold, and I recommended the GLD. I'm starting to think that maybe you should split that 7.5% between CEF and OUNZ, because we want to be in physical gold, not in paper. So I'm in the process of making that transition myself, and I'd recommend you do the same. Okay. Okay, so there's that. Don't buy less than 1 ounce of physical gold. The rake is just too high. Stick to the South African Krugerrand, American Liberty, and Canadian Maple Leafs. Please rate and review the podcast. That'll move us up higher on the list and keep this train running. So thank you for listening. Thank you for telling a friend. And thank you for tuning in. Here is your weekly motivational speech.
Here's the deal. If you get to the top of the tree, all the fruit from the bottom at the top is going to be there, son. So I don't need you focusing on cars and money and stuff. You're going to get that. I need you to focus on why you were born in the first place. Why are you here on earth for this particular time? What are you doing here? You need to tell you that you owe you something. I don't want nothing from you but for you to leave this room and know what you want. What do you want in your marriage? What do you want with your son and your daughter? What do you want in your health? What do you want financially? Like, how much money do you want to make a year? What do you want to drive? How do you want to live? Stop just waking up like an accident. What do you want? And then once you find out what you want, spend the rest of your natural life waking up and going after it. The reason why I speak with so much passion, E.T., why do you speak with so much authority? Because I'm talking about my life, not something that I read. I ate out of trash cans. You ain't got to start with the two-parent background. You ain't got to start with wealth. You ain't got to start with your parents graduated. It's not the hand that you dealt. You got rich kids who own drugs. You got rich kids who committed suicide. You got rich kids who don't know their purpose in life. It's not the hand that you was dealt, baby. It's how you play your hand. Every opportunity is the last opportunity. Every opportunity, I have to reprove myself again. Every opportunity, I'm still nervous. E.T., you've been doing this for years. Why are you so nervous? Because the day you become content, the day you stop evaluating yourself, the day you stop growing, the day you stop getting better is the day you die. Is the day the person who's trying to catch you will get you. And I ain't where I want to be. And I'm like, God, I ain't where I want to be. And he was like, you stop being a victim. I said, what you mean a victim? Well, it ain't my fault my mom got pregnant at 17. It ain't my fault my daddy wasn't there. It ain't my fault they couldn't get along. It ain't my fault. He said, boy, you grown. You ain't 10 no more. The decisions you make right now is up to you. You crying about something that happened to you when you was a kid. You ain't even no kid no more. You a grown man. Take full ownership. The stupid stuff you doing, your parents didn't make you play no video games. What you crying about? So what, your daddy wasn't there? Your mama ended up getting married. What you crying about? He went to work every day. He never beat you. He never abused you. Your mama did the best she knew how to do. What you crying about? You grew up in a house. What you crying about?